Today we're diving into an analysis report on Lucid Motors, ticker LCID.
An interesting one.
It is. The report looks at the stock's recent drop to about $12.58, but argues there's a massive 46% upside to the $18 analyst target.
Right, based on a few key catalysts?
Exactly. Revenue growth, the new Gravity SUV, and some big partnerships. So let's jump right in. First up, the overall tone and, the analytical rigor of the piece itself. I will say it does a very strong job of just listing out the bull case. You've got the Q3 revenue growth, 68% year over year. The Gravity SUV is highlighted, and of course, the stability from backers like the PIF, Uber, Aston Martin, it's all there.
It is, and the tone is definitely high energy. It kind of grabs you, tries to validate those fears about the stock drop before, flipping the script.
But that's where we run into our first issue. The report needs to shift its tone from highly promotional enthusiasm to the dispassionate rigor required of an objective analysis, particularly when discussing specific price targets and assessing market sentiment.
Yeah, that's the heart of the problem right there. It's a structural thing. I mean, the way it's written now, it leans so heavily into the language of conviction, not the language of probability.
What do you mean by that, exactly?
Well, it uses these really charged speculative phrases. Things like panic selling, right? Wrong. Or calling this the ultimate bear trap.
And the gift of the year, I saw that.
The gift of the year, exactly. And look, that kind of language is engaging, maybe for a quick social media post, but for a formal report, it really undermines the analytical credibility.
So it starts to feel more emotional than data-driven.
Precisely. And that's incredibly risky when you're attaching specific numbers to it, like an $18 or even a $24 price target.
Okay, but let me play devil's advocate for a second. If the goal is to convince a skeptical reader, shouldn't that high conviction, that emphatic language, help the argument?
You'd think so, but it actually creates this cognitive dissonance. A really solid analysis shouldn't need rhetoric to sell you on the conclusion. The facts should do the work.
I see.
When you use words like wrong or trap, you're telling the reader how to feel about the data, instead of just showing them the data and letting them connect the dots themselves. You want the numbers to carry the weight, not the adjectives.
So the suggestion here is to just recalibrate the language.
Exactly. Let the data speak for itself. Use objective, measured phrasing. Emphasize the potential, and maybe more importantly, the disparity between the current price and the valuation, rather than just declaring it's a trap or a gift.
Okay, so give me a concrete example. How would you change that opening?
Well, instead of that panic selling, right? Wrong line, you could frame it around the measurable financial anomaly. Something like LCID's current price of $12.58 represents a substantial 46% deviation from consensus analyst valuations. Then you say, this report explores the fundamental drivers that justify this measurable gap.
Much more analytical, less hype.
Right. And then for the conclusion, you have to get rid of the rhetoric. Asking if the stock is a falling knife or is it the gift of the year should be replaced.
Replaced with what?
With a defined probability matrix for that $18 target. What are the 2 or 3 primary quantitative conditions that have to be met in the next year? Specific production targets, margin improvements, whatever. And what's the report's assessment of the probability that those things happen?
That's a huge shift. It moves the report from just a declaration to a real prediction based on evidence.
That's the leap in rigor we're looking for.
That framing shift is definitely key. Now, let's see how that same high conviction style kind of bled into the data presentation, specifically the technical analysis section. This section is pretty brief. It points out the stock is at $12.58, mentions the RSI is screaming oversold, and identifies $15 as the first major resistance.
Screaming oversold. Yeah, I saw that.
The idea is clear. A technical bounce is coming, and the fundamentals back it up. But the technical analysis is too generalized and needs to integrate stronger supporting data to justify the suggested snapback rally to the $18 target.
This is a critical area that needs to be expanded. Just saying the RSI is screaming oversold is, well, it's not enough for a rigorous analysis.
It's common language, though. You hear it all the time.
You do, but it lacks analytical depth because the RSI on its own is a terrible timing tool.
You're talking about the classic RSI trap, right? Where a stock is in a downtrend and the RSI can just stay oversold for weeks, even months, without a real reversal?
Exactly. The analysis here gives no context. Is there actual structural support at $12.58? It doesn't say. It also doesn't identify any specific triggers, like a volume surge or confirmation from another indicator, that would tell you a reversal is actually happening. You can't just assume the snapback. You have to define the trigger for it.
And what about that $15 resistance level?
It's just hanging there. This no definition. You have to tell the reader why $15 matters. Is it a previous support level that's now resistance? The 50-day moving average? And what does it mean structurally if we break through it?
So the suggestion is to tie the technicals much more closely to the fundamentals.
Yes, integrate them. Define the structural significance of that 1258 level. And then detail the necessary conditions, volume, time frame, maybe a catalyst from a news event, that are required to get through $15 and open up that path to 18.
So how would you ground that analysis? Give me an example.
Okay, first, define the historical context of 1258. Was this a previously tested support level, maybe from late 2022? Or is this a totally new low? Just giving it that historical significance anchors the technical floor.
And for the rebound trigger itself, that $15 mark?
You have to be very specific and measurable. Don't just say it's resistance. Spell out the implications of breaking it. For instance, a successful close above $15 on significant volume, say 25% above the 90-day average, would confirm the RSI reversal and clear the 50-day moving average.
I see.
Then you add signaling a potential gap fill back toward the $18 level. That gives the reader a concrete, observable trigger they can actually track.
And what about avoiding that RSI trap?
You must introduce a second indicator. Don't rely on just one. For instance, is the MACD showing a positive divergence? You know, where the price is making new lows, but the MACD's momentum is actually starting to turn up?
Or maybe Bollinger Bands?
Or Bollinger Bands, yeah. Is the price hitting 2 standard deviations below the mean? That's a statistical extreme. Bolstering the argument with a second piece of data makes the technical thesis so much stronger.
I agree completely. That takes it from a conversational observation to a robust two-factor thesis, which is critical because confidence in that technical rebound directly impacts your confidence in hitting those price targets. Okay, let's move to our third area, how the report handles risk. It does acknowledge risk, specifically high cash burn and the need for perfect execution on the Gravity launch, which is good.
Right, it mentions it.
Those risks by just pointing to the massive $5.5 billion in liquidity from the PIF. So the risk is cited and then almost immediately dismissed. To bolster the report's integrity, the acknowledged risks must be analyzed with the same rigor as the catalysts, rather than being briefly acknowledged and then dismissed by focusing solely on liquidity.
That structural choice is a real problem. By acknowledging a risk only to immediately negate it, it gives the impression that you're just trying to minimize operational challenges to support your bull case.
It makes the risk section feel like a box-checking exercise.
It does. And the discussion on cash burn is particularly weak because it's just countered by the PIF liquidity. We need to make a key distinction here. Liquidity solves solvency risk, the risk of the company just running out of money.
Okay.
But it does not solve the operational risk. That's the risk that the company burns through cash too quickly because it's failing to hit crucial execution milestones, like a perfect on-time launch of the Gravity SUV.
That is the essential insight that's missing here. Having $5.5 billion buys them time, but it doesn't guarantee efficiency.
Not at all.
The analysis should shift from asking, do they have enough cash, to are they spending that cash effectively enough to justify an $18 valuation?
Precisely. A strong analysis needs to contextualize the rate of that cash burn against their revenue, rather than just pointing to a big pile of cash. So the suggestion is to expand the risk assessment, establish clear, measurable execution milestones for that Gravity launch.
What kind of metrics?
Specific quarterly metrics, maybe margins per unit or initial production targets, things that would signal a failure of execution and put those price targets at risk, even with the PIF safety net.
So let's make that concrete. How would you apply that?
Well, instead of just talking about the total liquidity, provide an estimated cash burn runway based on the current burn rate. Tell the reader how many quarters that runway lasts if, say, the Gravity launch is delayed by 6 months.
Or if the production ramp-up misses its targets by 20%.
Exactly. That makes the operational risk tangible and quantifiable. And another thing, when you're analyzing the Gravity SUV, you can't just assume it's going to double annual revenue by 2027. That's a huge leap of faith.
So the risk analysis needs to get into the weeds of the launch itself.
Yes, discuss the specific challenges, the high capital expenditures for retooling the factories, the risk of supply chain delays with new battery tech, or the possibility of lower than projected